So one of my YouTube subscribers wanted me to give clarification about stages and bases because he was getting confused between a stage and a base. So on MarketSmith website, if he looks at stage number 3, so he's not able to understand whether it is base 3 or whether it is stage 3. So I want to give clarification, and for those of you who are new to my channel, this is a very important video. And for those of you who have been on this channel for some time, for you also, this video is going to be valuable. You will understand it when I start discussing. I will keep the video short. Okay. So there are basically 4 stages: stage 1, stage 2, stage 3, stage 4. A stock normally goes through 4 different stages. Stage 1 is called as the consolidation phase, where the volume is low. The stock is just consolidating. Nobody is really interested in buying the stock. It is just trying to buy some time. Stage 2 is the accumulation phase, where people are piling onto the stock. Retailers, institutional investors, everybody wants a slice of the pie because the stock is showing extraordinary growth in EPS and sales, return on equity, margins, and things like that. Stage number 3 is distribution. Distribution means the institutions who have made money on the stock, they are now distributing that stock to retail traders or investors. Stage number four is the decline phase, which is what Mark Minervini calls the capitulation phase. Capitulation phase. Okay. Where the stock is actually destroying wealth for you. So, consolidation, accumulation, distribution, capitulation. Okay. Or the decline phase. We, as swing and positional traders, we are interested in stage 2 only because this is where we can make money. In stage 1, you are wasting time. You are not wasting money, you are wasting time. Why are you not wasting money? Because the stock is just going sideways. Similarly, stage 3, you are wasting time, you are not wasting money because the stock is going sideways. Stage 4, you are wasting time and money, correct? Because the stock is actually destroying your wealth. Stage 2 is where you're actually going to earn profits. So that is why we are only interested in buying stocks which are stage 2, because we only do delivery based trades. I am not into short selling or intraday or futures and options and things like that. I like to buy stocks and take delivery, as simple as that. No margin trading facility, no loan, nothing. It's very simple. I have money in the trading account. I just buy the stock. That's it. Very simple. Okay. Stage 2 generally lasts 18 to 24 months. So inside stage 2, in general, there are 5 different bases. So there is stage and then there is base. Okay. So it looks something like this. So this is how stage 2 looks like. So assuming the sales and the EPS of the company continues to grow, there is a good chance, or there is a high probability, that the stock price will also continue to grow during that growth phase. And it has been observed that normally from base 1 to base 5, it takes around 18 to 24 months. That's the time period during which the stock continues to remain above the 50-day simple moving average. Now, 18 to 24 months is a long time period. That is for positional traders. Some stocks stay in above the 50-day simple moving average for 6 months, some for 8 months, some for 12 months, some for 18 months. Some of them could continue to form base number 9, base number 10. But in general, I am telling you, most of the stocks will have 5 bases. If you read Mark Minervini's book, you will understand that most of the times you will find 5 noticeable uh, bases which you can spot on the chart. Okay, on the weekly chart. Okay, from weekly you come down to the daily, you will see the same base, but it will be much longer because one week has 5 candles. Okay, from base 1 to base 3, in general, the stock normally doubles. Okay, from base 1 to base 5, it could be 300%, 400%. Okay, now From base 1 to base 5, as I said, generally the time period is 18 to 24 months. Base 1 to base 3 could be like 9 to 12 months. Okay. Now, when a stock breaks out of a base, ideally it should go up at least 20 to 25% before it forms another base. Okay. Or before you start counting the next base. This is very important because sometimes what happens is stock breaks out of base number 2, and you remember I said at least 20 to 25%, not maximum. It could be anything. I have shown you stocks on my YouTube channel where the stock broke out of a base number 3 and went up like 92% in less than a month. That could happen. That's an extended stock. But I am saying at least 20 25% it should go before we start actually counting the next base. Okay. Sometimes it goes up 40% without forming 10 candles in the base. So we need to start counting the next base from that 40% level. Correct. That is why I said from base 1 to base 3, it could be 100% growth. The stock could double. And from here to here, the stock could double again. So from base 1 to base 5, that's a 4x kind of a return. The stock has gone up 4 times. That's a 300% return. Correct? That could happen. So there is no black and white in trading. We don't know how much a stock could go up. But if I am buying a stock, let's say at base 2 with a stop loss of 8%, I want like 2.5 to 3 times my risk as my reward. So 8% multiplied by 3 times my risk, that is 24%. So I want the stock to go up at least 24% for me to be, for the reward to risk to be justified for me to take that trade, right? If it goes up 20%, it's like 2.5 times. And 2.5 times reward to risk is a very good reward to risk. Imagine taking 10 trades with a reward to risk ratio of 2.5 is to 1. If you make money on 3 trades, lose money on 7 trades, on the 7 trades you lose 7, but on the 3 trades you make 7.5. So, in effect, theoretically at least, even if you get 3 out of 10 trades right, you will end up making a profit. So, that's the value of reward to risk ratio of 2.5 is to 1. So minimum 2.5 is to 1 reward to risk trade. If we take, we are taking the right risk management decision. If I am taking 8% risk, I want minimum 20%. So 8 multiplied by 2.5. Okay. So keep these things in mind. 20 to 25%. That's what I am expecting because I'm keeping my risk level at 8%. So that's roughly approximately 2.5 to 3 is to 1 reward to risk ratio. So when a stock breaks out of a base, we want that stock to go up at least 20 to 25%. And generally that happens. Sometimes it extends beyond 25%. Sometimes it would go up 40%, 100% without forming 10 candle, a 10 candle base. Now, when that happens, that's an extended stock. If one stock breaks out of base 3, goes up 100%, chances are very low that it will form a base at that point in time. It could start to fall. You could look at the recent chart of GRSC, Garden Reach Shipping Enterprises. Okay, you can check the chart. I had discussed this on my YouTube channel. So after every base, we want the stock to go up 20 to 25%. So if the base is long enough, that is most likely to happen. Another point I wanted to make, let's say the stock breaks out of base number 2. Instead of going 20 25%, it goes up 5 to 10% only. And then again starts consolidating, again starts to form a base. So that base would be called base 2B. This is base 2A. It goes up like 5 to 10%. Again, it starts to form another base, starts to consolidate. That is base 2B. From base 2B, it breaks out again. Again, instead of going up 20 25%, again it goes up like 10% outside that base. And then again starts consolidating. That is base 2C. I think that is what Market Smith is doing when they say this is base 2A, 2B, or 2C. Okay, that is my understanding of the platform. And in my view, they are right, because generally when a stock breaks out of a base, it should give 20-25%, because the point at which the breakout happens, there the retail supply is at its lowest. So institutions are trying to pile on to the stock. So institutions could end up paying 20-25% more for the stock just to get a hold of that stock. Because when one institution is buying from another institution, they will have to pay a premium, okay, to kick those institutions out. Anyways, coming back to the discussion, when a stock breaks out of a base, doesn't go up 20-25%, it might start forming the next base. So that's a sub base. So there is stage two. Within stage two, there are generally five bases in most cases. Those five bases can be further split into three sub bases, two or three sub bases for each base. So base 1A, 1B, or base 2A, 2B, 2C, or base 3A, 3B, or base 4. After base 4, it could go up 20%. So there won't be 4A, 4B. There you will directly go to base number 5. So that is how you have to look at bases. And this is a weekly, this is what you will see on the weekly time frame chart. Come down to the daily, the base will look slightly longer. It's one and the same thing. Now, since MarketSmith already gives us the count of the base, I don't look at the weekly chart. Why should I waste my time on the weekly chart? The answer is already given on the MarketSmith platform. That is why I pay to get that information. Okay. So remember, there is stage, there is base, and there is sub base. Okay. Thank you so much.